Thanks for inviting us to the learning session tonight. We are excited to learn and discuss on interesting topics related to finance and investment to aid preparation for the final exam.
Yes, we were wondering if we want to know something new and different. Could you share the topic that you chose to present us today?
Certainly, today our group will present the topic of risk and return, which is one of the most important concepts of finance and investment. And the purpose is to understand the relationship between risk and the return on investment, decision and financial management.
Okay, let's get started.
First, let us look at the introduction to risk and returns. So risk and returns are considered as the two pillars of every investment, of every decision making in investment, because investors always have to balance the potential rewards against uncertainties. Now let's look at risk. So risk refers to the uncertainty surrounding an investment and the possibility that the actual returns are actually different from the expected returns. But investors may face different types of risk, such as credit risk, market risk, liquidity risk, and specific risk. Now we move on to the returns. So what is returns? So return refers to the gain generated from the invested capitals. If the investment earns more than the original price, then that means that it is considered as a positive investment. However, when the returns is also considered as a negative when losses occurs.
So now I will continue on the presentation. Risk and return analysis serves several important objectives. So it helps assess risk accurately by identifying market, credit, and liquidity risk before investing. Moreover, it enables form investment choices by comparing opportunities according to their risk-return profile, while helping investors set realistic financial goals and returns expectation. In addition, it also allows investor and fund manager to evaluate portfolios and performance and determine whether the returns are appropriate for the level of risk. And finally, it supports better asset allocation by balancing growth and opportunity at acceptable levels of risk. And before making investment, investor must evaluate their risk appetite. There are three important dimensions that investors should reconsider. First of all, is the ability to take risk. It depends on income stability, financial resources, and investment horizontal and existing financial obligation. Second is that the willingness to take the risk. It reflects an investor's personal attitude and emotional comfort toward uncertainty and potential losses. Some investors are comfortable with market fluctuation, while others prefer stability and security. The third is that the need to take the risk. It relates to the level of required to achieve specific financial goals, such as saving for retirement, education, or wealth accumulation. Investors who need higher return may have to accept greater risk.
So lastly, I will explain important method used to calculate and evaluate risk return, namely alpha ratio, beta ratio, and Sharpe ratio. So alpha makes sure the exists return earned by investment compared to the benchmark index. In other words, it show whatever an investment perform better or worse than the market. For example, if a mutual fund outperformance is benchmarked by 1%, it has an alpha positive 1. If under 1%, it have an alpha negative 1. So for the second measure is beta ratio. Beta measure how sensitive or correlate a stock is compared to the overall market. Beta 1 means the stock move closely with the market, and beta greater than 1 is indicate higher volatility than the market, while beta below 1 indicate lower volatility. So for the final measure is the Sharpe ratio. The Sharpe ratio evaluates whatever the return it was the level of risk taken. It's compared to the adjusted return of investment to standard valuation, which measure volatility. Generally, a high Sharpe ratio is the better because it indicates a more attractive risk-adjusted return. So
all in all, risk and return are essential in finance and investment because they help investors understand the balance between potential profit and uncertainty in return. And generally, higher risk lead to higher potential reward. Risk and return analysis help investors make informed decisions, evaluate investment and performance, and manage portfolio effectively. Investors should consider their ability and willingness and need to take risk before investing. Tools such as alpha, beta, and Sharpe ratio are commonly used to measure risk and return, while diversification, and long-term planning help reduce investment risk. Thank you, everyone.
Okay, great.